Meantime, Citigroup is among the few outliers, very few, still calling for a hike today, to Tyler's point. They're saying, quote, core inflation by a number of measures has been at or above 5% for 2 years. Despite markets pricing very little chance of a hike, we maintain our base case for a quarter point. But our next two guests disagree. They see a pause today and no hikes for the rest of this year. Joining us here in the studio is Jamie Cox, managing partner at Harris Financial Group. And Subadra Rajappa is also with us. She's head of U.S. rate strategy at Societe Generale. Welcome to you both. Jamie, I'll just start with you and kind of react to the atmosphere out there. This is widely expected, but Citi says, hey, there's still a chance they could hike.
Well, it's an asymmetric thing for Citi. If you're right, you're a genius. If you're wrong, nobody's paying attention. So to me, absolutely.
I think they look bad. They're the only one out. No, people like to go with the group.
People do this all the time. This is something that happens when people are calling for recessions. They keep calling and calling and calling. When it finally comes, they take the lap around and say, I won. That's exactly what they would do in this case. But we're going to pause. The Fed needs to pause. We have a credit crunch that they have to factor into the deal. And I believe that we have not yet seen the effects of it. In fact, I think Nick Timirath said it best in his Wall Street Journal article where he talked about tapping the bottle of ketchup, where you tap, 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 and then all of a sudden the ketchup rolls out of the bottle all at once. That could be what we would see with the credit crunch. We don't see it, and all of a sudden we do. And I think that's why the pause, and probably the pause, is going to be permanent.
And this is partly why you've been a little critical of the Fed, right? You thought they should have paused last time, and you have other criticisms of the Fed. Why? What do you think they've done wrong?
Well, I mean, it's obvious.
Because right now the economy is okay.
Well, the economic growth is good because they printed ungodly amounts of money, right? I mean, you flooded the system with money.
Through quantitative easing.
But before that, I mean, before even the pandemic, you had QE and other interest rate pauses in 2019. So basically what happened was the Fed primed the pump, and then they waited too long, and then they had to raise interest rates rather quickly. So basically, they created the problem, then had to fix it. So that's why I've been critical of it, because they were too late. They let inflation get stoked and actually become more permanent and entrenched. That's the problem.
I think that's a fair point. Subadra, let's bring you in here. What are the implications across rates and the financial markets?
Yeah, no, I think that I agree with what Jamie's saying. It makes sense for the Fed to keep rates on hold for the remainder of the year. And as far as policy goes, I think the most important thing that I heard over the last 3 weeks is from, Governor Jefferson, where he said that there's about a 1-year lag between policy and the transmission mechanism into the broader economy. So which means that some of the rate hikes that were delivered last year this time, the impact of that is still being felt by the broader markets. So in this sort of context, it makes sense for them to keep policy on hold for the remainder of the year. You know, from where we are right now, we don't really see any imminent signs of a recession. But you look at credit conditions broadly, the Senior Loan Officer Survey and other surveys, you tend to see that, the banking credit crunch is getting a little bit more crunchier. So as we progress through the year, if rates are static where they are, I think that should do the job of tightening financial conditions, leading us potentially to a recession in early 2024. In this sort of context, I think you're going to see a gradual decline in 10-year yields over the remainder of the year.
So you just mentioned the idea of a possible recession in, thinking about weddings, recession in 2024. If my recollection is correct, last year everybody was saying, well, the recession is not going to be a 2022 thing. It's going to be a 2023 thing. Maybe first half, maybe second half. We get into 2023. Now it's become a 2024 thing. What's happening here, and why is this widely talked about recession not happening and seemingly being pushed off farther and farther into the future?
So our economists have had a call for a recession in early 2024. As early as August of last year. So we've kind of kept that messaging very, very consistent.
Well, bless your hearts then. That's good. Good for you.
But, broadly speaking, it's the strength in the labor market. We've seen the unemployment rate rise from 3.4% to 3.7% in the last print. But the unemployment rate remains very, very low. And the labor market, for the most part, remains very, very tight. You look at the JOLTS job report, the amount of openings versus, the unemployed, it's still at 1.8%. So you're looking at really a very, very tight labor market in the big scheme of things. Consumers have remained extremely resilient. So that's really pushing out the window for the recession into 2024.